Okay, let's get started again. I've just switched my internet to Airtel. We hope Airtel will give us a better service. Huh? Okay. So let's move, guys. We started off by saying that we need to start with a definition of an exchange rate. And we have seen a typical economics definition. An exchange rate is the rate at which one country's currency can be traded in exchange for another. And I was just in the process of saying that as a traditional management accountant, maybe I would prefer the second one, which says an exchange rate is simply a price that we pay for a product. What is a product? The product is one unity of foreign currency. And normally we say FX. So think of an exchange rate in a very simple way. And the simple way of thinking of it is just to think of an exchange rate as a price that you pay for any product. So it could be you're buying $1 US, how much will it cost you? Or you're buying £1, or you're buying one South African rand, or you're buying €1. How much will this cost you? So we may think of an exchange rate in terms of the price that we pay for each one of these products that we have listed here. Okay. We now want to understand the concept of exchange rate a bit more. The spot exchange rate is the rate at which currencies can be bought or traded for immediate delivery. So the price paid for immediate delivery is what we call a spot rate. So a spot exchange rate is the rate or the price that you pay to buy $1 immediately. The forward exchange rate is an exchange rate set for currencies to be exchanged at a future date. So a forward rate is the rate that we agree today. So a forward rate is agreed today, but the delivery of the currency or the exchange of the currency will take place in the future. So when that time comes, you already know the rates to use. So a forward rate is a rate that we agree today, so that when tomorrow comes, we know the price at which you buy or sell our currencies. Now let's come to probably a more important slide. We need to understand the difference between a direct and indirect quotation. A direct quotation system is a system which expresses the exchange rates in terms of units of domestic currency. Which are equal to 1 unit of foreign currency. And we have said this is a system typically that we use in Zambia. In Zambia, we normally talk about so many kwachas. So many kwachas per single US dollar. So many kwachas for so many rands. And so many kwachas for the British pound. So in Zambia, our exchange rates start with our own currency. That is called a direct quotation. And this is the normal way of quoting a price. Whatever price, a product you're buying or selling, it will be so many kwachas. That is called a direct quotation system. Now I know that you've got a colleague in the South African market here. Let me see if she's here. Yes, please. Is it Kamana? Tell us something. How are your exchange rates expressed in South Africa? In South Africa, how are exchange rates? What do you start with?
So we'll start with the rand to the dollar or the rand to the pound.
So you also talk about rands there, starting with rands. Yeah.
Yes.
Like now, how many rands do you need to buy a dollar? Would you remember how many?
So I didn't check the latest numbers. I didn't check the latest numbers. So I'm not sure at the moment.
In the past 2 months, or this year, it has been around what on average?
I think it was around 16, I think, if I'm not mistaken.
Yeah. No, that sounds right. Because yourself with our currency, we're almost on 1-to-1. We're hovering somewhere around there. So it makes sense that even for you, maybe yours is slightly above us. So it makes sense that you're buying a dollar at 16. Eh? Yeah, but there was a time when dollars were quite cheap in South Africa. There was a time 2000 somewhere there. You pay so little for a dollar. Yeah. So 16 rands to a single dollar. Okay. So that system where you're starting with rands or your local currency, we call it a domestic quotation system. For examination, it's very important to understand the type of quotation which is being used in a question. And as we go through questions, I'll keep on commenting on this. Now, there's something important here. Two rates always quoted are the bank's buying rate and the bank's selling rate. So whenever you go to the bureau or to the bank, there are two rates. There are two rates. And this is the kwacha to a dollar or rand to a dollar. Now you need to understand what these two rates mean. For you to give correct advice, remember this paper is advisory. So for you to give correct advice, you need to know what do these rates mean. One of these rates, the bank will use it when they're buying from one customer. Another one when they are selling to the next customer. So these rates that we see, one of them is the buying rate, another one is the selling rate. That's what we're saying here. Two rates always quoted like here are the bank's buying rate and the bank's selling rate. So which one will the bank use when they are buying? Which one are they going to use when they are selling? Because that's what our advice is based on. Here's your answer. In a direct quotation system, like the one that we have in Zambia and South Africa, the normal rules of business apply. Dealers like the banks buy at a low price and sell at a high price. So here, the bank will buy $1 from Mr. Piri. So they'll buy from me $1 at 16.48. And they'll sell it to Mr. Nkunguru immediately for the 17.24. And we can see the business sense there. Eh? We can see the commercial logic, isn't it? Are we able to see the commercial logic there? The bank bought $1 from Mr. Piri and they paid 16.48 watch. And they are selling immediately Mr. Nkunguru at 17.24. Certainly, they have made a profit. The difference represents their profit or their margin. Okay. I picked this. This is some time ago when I picked this. Banks buy and banks selling. And we're interested in the US dollar here. We've also got a rand here, a colleague there from SA. So meaning that on this particular day, Stanbic was buying $1 from their customers at 18.1346 and selling the same at 18.4954. The difference represents what? The margin. The difference represents the margin. The banks were buying rands. So if we had rands, the bank would buy and the bank could sell at that rate. Now, have you noticed the language that I'm using? These words, buying and selling, I'm using them in relation to who? In relation to who? To the bank. I'm saying the bank's buying rate. The bank buying from Mr. Piri, and the bank selling to Mr. Konguru. So it's important to take note of the terminology. So the bank buying and the bank selling. So if you're going to give a correct advice about what a company should do, you must first tell us which rate is the buying rate and which one is the selling rate. Further, so on that particular day, the bank would buy $10,000 from Mr. Piri. So if I have $10,000, I give the bank buying from me at this rate. Okay, so what will happen? The bank would give me this amount of money. The bank will buy $10,000 from me. The bank would take the $10,000 and sell to Mr. Konguru at that. And Mr. Konguru is going to pay the bank $184. So the bank bought $10,000 for how much? And they sold it for how much? And the difference represents the margins. We call this understanding the exchange rate. Before we talk about the what? The risk. Now we come to something else here, an indirect quotation system. This system expresses exchange rates in terms of units of foreign currency, which are equal to 1 unit of domestic currency. Now here the story changes. If we look at the UK, the UK expresses their exchange rates using the indirect quotation system. So in this system, they start with units of foreign currency. So then they talk about so much dollars to a pound, so much Japanese yen to a pound, so much euro to a pound. This is a system which we call indirect. Now, if we come to the issue of which is the bank's buying rate, which is the bank's selling rate, then the story changes. The buying rate and the selling rate depends on what quotation system are you using. That's what it comes to. Understanding exchange rate, two rates always quoted are the bank buying rate and the bank selling rate. In an indirect quotation system, if you establish that the situation you're looking at uses indirect quotation systems, the opposite happens. The bank buys high and sells low. The high rate is used when the bank is buying. And the low rate is used when the bank is selling. I'll leave out that example there. I'll set up our own. Let's set up our own example. For now, we'll ignore this. I'll come to this later. So we're in the UK. Look at this scenario. So these are dollars on a single pound, like that. We've got 1.2478 to 1.2498. So this is the quotation system which you have been presented with on a UK electronic exchange rate board. Now what we are saying is that what type of a quotation system are we facing here? It's indirect. Because we are starting with units of foreign currency. So which one is the bank's buying rate, which is the bank's selling rate? We are saying the bank will use the high rate, this one, when they are buying from the customer. And they use this one when they are selling. So let's take a particular customer. Let's take $250,000. So when the bank is buying $250,000 from one customer, how much are they going to give him? In an indirect quotation system, we always divide. We always divide. When you are moving from the foreign currency to domestic, in this system, we always divide. So like in the UK, the bank is buying this amount from one customer. They'll use a higher rate, 1.2498. That's the rate they'll use. Somebody can help me with the answer. Somebody help me with the answer.
It's 200.03. Or 200,000 03. 200,000 032.00.
So 200.
200 032 032.01.
Buys. Now let the bank sell the same amount. Let the bank sell the same amount. So they bought this. Now they are selling to the next customer, and we are saying they use a lower rate, which is 1.2478. How much will the bank sell this for? Then they paid this. When they're selling, let's go. How much is that?
So we have 200, 352.62.
Have you seen the logic now? Team, have you seen the logic of what's happening? Have you seen the logic? The bank bought $250,000. They only paid this amount. When they are selling this amount, they collect how much? Are you seeing the logic? What does this example show us? This example confirms that if you have an indirect quotation system, the high rate is used when the bank is doing what? The high rate is used when the bank is doing what?
Buying.
Buying. And the low rate is used when the bank is doing what? Selling. And also we have seen that in the indirect quotation system, what do you do when you're moving from foreign currency to domestic? What do you do? What do you do?
Divide.
Yeah. In the domestic, in the direct quotation, it's different. When you want to find what's the value of $1,000, what's the value of $1,000? What are you going to do? Multiply. These are some of the things we want you to pick. These are some of the things we want you to pick. You know, once you pick these basics, the questions will not trouble you a lot. So these must be on our fingertips. This must be on our fingertips. Let's get to the bottom of the problem. The problem is currency risk. The topic is about risk. So what causes currency risk? How does it arise? This risk is created by what? In what? In exchange rates. Currency risk is created by the fluctuations in the exchange rates. So the question is very simply, like in the die quotation, you import a laptop for $500. Currently, the rate is 16. But you're expected to pay 1st of July. 1st of July, the rate may go to what? 18. So instead of multiplying this by that, you now multiply 500 by 18. So fluctuation in exchange rate is what causes a problem. If the exchange rate is stable, even if it's high, but it's stable, the whole 2022, the whole 2023, the whole 2024, the rate is stable. This is okay. If you can know how much you're going to pay for $500 for the next 3 years, the amount is, we are saying then there's no risk. So the risk arises basically when there's fluctuations, the ups and downs. Now the question is, what causes a fluctuation? One, there are those who are speculating. There are those who are gambling. These are people who are the culprits who are causing this. They are buying and selling. When they hear that IMF is coming, what do? Like now they've heard IMF is coming. What do? What are some people doing?
One rate of what? They're selling dollars.
They are selling. They are selling dollars because they've heard IMF, and we've been told that how much are they likely to bring into the market? How much are they likely to bring? It's $1.2 billion. Their package. Whatever it is. Come again?
But I think 1.3.
1.3 billion. So if 1.3 billion comes on this market, that's quite a good amount of money for our economy. For the size of our economy, this is good money, and depending on the programs where I want to use this money, depending on the programs where I want to use this, a lot of money. Meaning that for the foreseeable future, we're going to have enough dollars. So those people, what are they doing? When they say no, IMF has slowed down, what happens? They stop selling, or some people, they start buying. These people call them speculators or gamblers. The government action also, sometimes when the currency depreciates too much, the government may move in to save the currency. So the government may buy the kwacha, or they may sell the dollars. That's government action. Balance of payment. Balance of payment. In simple terms, what are we talking about here? Exports and imports. Exports and imports. We are a serious importing nation. And that is why all of us are looking for dollars. So businessmen and women are looking for dollars on our behalf. To pay for what? For the imports. I always say that, if you want to check whether this is true, if you want to check, go to these places. Go to your fridges and also go to your wardrobes. Go here. Most of the food that you have in the fridge, Mr. Nkunguru, most of the food you have in the fridge, is it local? Mr. Nkunguru, most of the food you have in the fridge, is it local? It seems to have dropped, eh? Mr. Nkunguru seems to have dropped. I can't see him here. Yeah, most of the food that we have in our fridges, Mr. Kalas, most of the food we have in our fridges, where is it local?
No.
No.
Imported.
If you buy local food like peanut butter, if you buy the Chalimbana one, what happens? What happens if you buy, there's a lot of mothers, Mutinta, if you buy the local peanut butter, the Chalimbana one, what happens? What's the reaction? I'm told children refuse to eat. Children protest. They don't want the local, but the imported one. But what's the impact? The impact is that our suppliers, businessmen and women are looking for what? They're looking for dollars to support the imports. Now that demand for dollars certainly has got an impact on the dollar because the dollar is ever expensive. The dollar is ever expensive because there's so much demand for it to support the imports. High interest rates are associated with depreciation of the currency. High inflation rates are associated with the depreciation of the currency. So yes, the exchange rate does fluctuate, not just because of one factor, but because of a combination of factors. But there are some factors which have got more impact at specific points in time. Like when there's anticipations, like the IMF we're talking about, that may cause a fluctuation. But basically, it's all these put together. They explain the fluctuation in the exchange rate. When there's a fluctuation in exchange rate, there's three types of risk. When there's a fluctuation in exchange rate, there's three types of risk. What are those risks? Transaction exposure, translation exposure, and economic exposure. These are the three risks which arise from a fluctuation in the exchange rate. You must be able to explain and distinguish these types of risk. Examiners say that our students cannot explain these risks very well. The examiner is saying that the students, even at advanced financial management, cannot explain these risks very well. So let's talk about these risks. What's transaction exposure? The risk of adverse exchange rate movement occurring in the course of normal international trading transaction. In a normal transaction. Normal international trading transaction. This arises when the prices of imports or exports are fixed in foreign currency terms, and there is a movement in the exchange rate between the date when the price is agreed and the date when the cash is paid or received in settlement. Like the example I've given. You import a laptop. That's very normal. So this is in the course of normal trade for $500. So that you have been invoiced in dollars, but the payment is tomorrow, 1st of July. 1st of July. There's a possibility that the dollar can become expensive between now and that date. This is called transaction exposure. Or maybe you have not imported, but you have exported. So you have invoiced your customer yourself $500. And again, you have agreed that he's going to pay on the 1st of July. So what will happen on that day? So what will happen on that day? Translation exposure caused by us accountants. This is caused by us accountants. Why? Because we want to consolidate accounts. We've got an operation in Africa. We've got an operation in Asia. We've got an operation in North America. So at the end of the day, you want to consolidate. You want all these to be reported on in the British pound. Certain need to convert variables from there, variables from there, and variables from there. You need to convert all these into what? Into British pound, so that you can consolidate your operations. So there's an issue of exchange rate here. There's an issue of exchange rate. The exchange rate, if you use different exchange rates at the beginning and the closing of the year, certainly there will be difference. That difference is called the translation exposure. So we say this occurs in multinational corporations that have subsidiaries with assets and liabilities denominated in foreign currency. Translation risk is the risk that the organization will make exchange losses when the accounting results of its foreign branches or subsidiaries are translated into the home currency. So these results from Africa, like we have said, from the USA, from Asia, when all these results are converted into domestic currency, which is the pound, there's a possibility of a loss. Translation losses can result, for example, from restating the book value of a foreign subsidiary's assets at the exchange rate on the statement of financial position date. The effect of translation risk is to create gains or losses in the reported financial results of the parent group, but they don't create cash flow gains or losses. So there's no cash flow. These are paper. These are on paper. Okay. What of economic exposure? What is economic exposure? This refers to the effect of exchange rate movement on the international competitiveness of a company. Now we are saying international competitiveness, meaning that you can become less competitive. You can lose customers, your competitors. Why? Purely because of exchange rate movement. And refers to the effect on the present value of long-term cash flows. It is a risk that over time a currency will depreciate or appreciate in value against other currencies, so that the company's economy becomes more or less competitive. The example that I have given is in Japan. Japanese motor traders have traded with us, have exported second-hand vehicles to Zambia for quite many years now. So they export. And that's good business. That's international trade. But now let's look at the reality. So here's a customer in Zambia. We have a customer in Zambia or customers in Zambia. $1 was 9 kwacha. So if you want to buy a car, you go and buy your dollars at that price. Very affordable. What happened? What happened? What happened? What happened? What happened? The dollar, which the customer needs, has been going up like that. What do you think will happen to customers? Will they continue to import? Will they continue to import? Hmm?
No.
No. So what will the Japanese motor traders see in terms of volumes?
The volumes will start reducing.
They reduce and reduce and reduce. What will happen to his cash flows?
The cash flows will reduce also.
And what will happen to the value of his business? What will happen to the value of his business?
Contract.
This is what we call economic risk, economic exposure. The fact that there's an exchange rate movement and its effect is to make your goods uncompetitive, your goods too expensive. That's what we mean. So what advice do we give this man? This motor trader, what advice do we give him? He must not only have customers in a country code one. You must diverse. So you must have a broad base. You should have a broad base of customers. So that, okay, as customers here have a challenge, then you go to other markets as well. So how you manage this risk is broaden the base of your customers. It's not just on the customer side, it could also be on the suppliers. There's two traders here. One trader imports their items from China. Their competitor imports theirs from the USA. Then the dollar becomes expensive. What happens? Your input has become expensive, you need to increase the price, isn't it? Imagine this one, the price hasn't changed. They're still giving you the same. What will happen? Your customers will move to this one. Your product will become expensive now. You see that? So we are going to see customers moving that way. They're moving that way. What happens? You're going to see a drop in your cash flows. Why? It's because the dollar or the input cost, one of the input costs which we are importing, has really gone up. So we have become less competitive. So that is what we mean by the concept of being competitive. Now, does it mean that this only affects those in international trade? Unfortunately, no. Unfortunately, no. It can even affect a firm not involved in foreign currency transactions. Let us take a local manufacturer of furniture. Here is a local trader. He makes furniture, an entrepreneur at Mandevu there. So he just uses local materials, and then from there he sells locally. That's what he does, and he's making good business. And we assume that the current exchange rate for $1 is 17 kwacha. So if we want to buy or to import furniture, this is too expensive. Imagine tomorrow we have a miracle and this drops to 10 kwacha. Those people want very nice furniture, state of the art. What are they going to do? Those who want a modern furniture, now that the dollar is on 10 kwacha, what are they going to do? What are they going to do? They're going to import, isn't it? It's affordable.
To import.
What will this man see? What is he going to see in his orders? What is going to see in his orders? Is likely to see a drop. Is there any mistakes? Is there anything wrong he has done? No. This man is likely to see a drop in his cash flows. Why? It's because the imported items have become cheaper, arising from the appreciation in the kwacha. So the imported items have become cheaper because of the reduced cost of the imports. That's the example we have here. A local firm producing for home markets without importing any raw material could suffer if the local currency appreciated in value as imports will become cheaper. That's what we mean by economic exposure. So how do you manage economic exposure? We have seen that you must have suppliers based in different jurisdictions. Also, even customers, you must have customers in different places. But also you need to strengthen your brand in terms of quality. Because this man was spoken about here, if his quality is very good, if his quality is very, very good, his quality is world class, he may not expect any losses. If he serves his customers very well, gives very good support, and the quality of work is good, you won't expect that drop. Okay. If your inputs are coming from, you import your inputs and they become expensive, so you push up the price. If the quality of your product is good, customers will have no problem. If your quality is good, the customers will have no problem. We come to the next item of our discussion, estimating the forward rates. So let's take a brief break here. Let's take a brief break. This is theory before we get confused. Let's take 5 minutes, okay? So after 5 minutes, we'll make it 17:30. We come back and we continue with our discussion. Right. All right, let's take off after our short break. One of the important exercises on this topic, which we saw also on overseas investments, is how to estimate the forward rate. Estimation of the forward rates is an important exercise here on this topic. But we also saw it even when it came to overseas investments, that you need to know how to calculate or estimate forward rates. There are three possibilities. You can use the interest rate parity theory, meaning the interest rate differential between the two currencies. What are the interest rates on the dollar? What are the interest rates on the pound? The differences in the interest rates can be used as a basis for estimating a forward rate. Purchasing power parity theory. This one says we can use the differences in the inflation rate. Differences in the inflation rate can also be used. So you can say, what is the inflation rate in the USA and what is it expected to be? What are the expected rates in the UK? So the inflation rate differential can also be used. Exchange rates, forward rates can also be costed as a discount. At a discount or premium to the spot rate. So that is another way. So we can take our spot rate and adjust it using a discount and a premium. So whether we are going to add or to subtract the premium would depend on the quotation system that we use. So whether you add, where adjustment is an addition or it's a subtraction, depends on the quotation system. Now you know what I mean by quotation system. You have covered two quotation systems. What are those? You have covered the direct and the indirect. So whether you're going to add or subtract depends on whether they're using a direct quotation system or the indirect quotation system. So let us say, let's start with our interest rate parity, interest rate differential. So how do you move from the spot rate and to convert to a forward rate? So how can you get a forward rate from a spot rate using interest rate? Here's the answer. So many dollars on a single point. So many dollars on a single pound. So it's important to notice this. So here we are starting with so many dollars on a single pound. So many dollars on a single pound. So what you do is you take the spot rate in that format and you multiply by 1 plus the interest rate on the dollar. So this one goes on top here. And this one comes down there. We've noticed that dollar, dollar, and dollar. Interest rates in the dollar goes on top, interest rate in the pound comes down. The difference between the spot and forward rates reflects the differences in the interest rates. That is what the interest rate parity theory says. That's what the interest rate parity theory says. Okay. That's what this says. The difference between the spot and forward rates reflects a difference in the interest rates between the two currencies. What of the purchasing power parity theory? Again, the forward rate in that format, look at the format, can be calculated by taking the spot rate in the same format. Again, the inflation rate on the dollar and the inflation rate on the pound. So I here stands for inflation. I here stands for inflation. Purchasing power parity theory predicts that the exchange rate value of foreign currency depends on the relative purchasing power of each currency in its own home country, and that spot exchange rates will vary over time according to the relative price changes. Let's do a small illustration here. Assuming that we are given the foreign economic variables, dollars on a pound. So meaning that if you want to buy 1 pound, that's what this means. Inflation rates, and these are annual rates. These are annual rates, inflation rates in the UK, in the USA. The question is estimate a 12 months forward rate. The next one is to estimate a 3-month rate. So how do you do that? Remember what we said? Remember what we said? The forward rate. In the format can be found as you take the spot rate, which is in the format, that format. Then you multiply by 1 plus the rate. This rate, what you put? And here, that's what you do. So in our case, this is $12.2495. So these are dollars on a single pound. So what do? You're going to take 1.2495, which is the spot rate. You're going to multiply by 1 plus interest rate in the dollar. So the dollar goes on top. So in the dollar, which is this, so 1 plus 9%. That's 1.09. Down here, 1 plus 6% in the UK, that's 1.06. So to find a 12 months forward rate, we just take that one, divide by this differential. If it's 3 months, you need to go back to these rates and prorate them. The 6 months multiplied by 3/12. And the 9 months multiplied by that. So we take that, multiply by 1 plus 5 and that. So this is what we get as a forward rate for 3 months. The only difference is that we had to prorate the rate first because these rates are per what? Are per annum. These are annual rates. So we need to prorate them. We need to prorate this rate by 6 multiplied by 3/12. 9 multiplied by 3/12. Okay, so this is how we can use the inflation rate to move from where? We're moving from where? Getting to where?
Forward rate.
Yes. So this is an important skill. Huh? Well, now I told you about discounts that you can be given a spot rate. And then you are given a discount or a premium so that we can move to the forward rate. So how do you move? The answer depends on the quotation system. If you're using a direct quotation system, what do? Discounts, you say less. Premiums, you add. In what system? Direct. Direct is a normal, that's a normal practice. If you go to the shop and somebody says, oh, there's a kind price. The kind price is so much. You go to the shop and you say, I'm offering you a discount. So what is the amount payable? You take this and then you subtract what? You subtract the discount. That's what is happening here. Discounts are subtracted. Premiums are added. In an indirect quotation system, it's different. Discounts are added and premiums are subtracted. On our paper, this is not common. This is not very common. Managing transaction exposure. So let's talk about transaction exposure. What's transaction exposure again? What's transaction exposure? Your invoice today in for payment or for settlement. Tomorrow. So if your invoice or even yourself, you invoice somebody in foreign currency for payment tomorrow, you have got an exposure called what? Transaction companies the methods that you can use. What are these methods? One, currency of invoice. The motor traders locally, what do? How do they manage the exchange rate? The invoice is in dollars or the stable currency. So if you want to manage the risk, invoice your customers in the stable currency, e.g. the US dollar. Leads and lags. What is a lead? An advance payment. If you expect that the currency is very expensive, make an advance payment. If you suspect that the currency will be cheaper in the future, you delay. So this is an advance payment. And this is a delayed payment to take advantage of a better price. Alternatively, you can match your receipts and your payments. If you're a company, you're running a hotel in Zambia, and you've got some invoices in South African rand. You buy some of your ingredients from South Africa. So from time to time, you're looking for rands to go and make a payment for those ingredients. The customers that come to your hotel are also allowed to pay in rands. this is a perfect situation for a matching because you've got receipts in what? In rands. You receive money in rands. And you've also got payment to make in what? In rands. So what you do is when your customers pay you rands, don't convert them, open an account, put all those monies in an account, open a rand account. And when you have to make a payment from there. What are you doing? You're matching receipts and payments. So if you're a company that receives a particular foreign currency and you have to make a payment, our simple suggestion is you match the receipts and the payments. So under the internal methods, you don't have to go outside the organization, no. But now these methods may not be adequate. These methods may not be adequate, so you need to go outside now. Well, we can use the forward contracts, the money markets, the futures, the options, and the swaps. In our next class, we're going to go into the external methods. We'll start with the forward contracts and also the money markets. So this is what we'll do in our class on Tuesday. So that by the time we hit Thursday class, we'll be looking at exam type questions using forward contracts, money markets, and also by Thursday we'll be introducing the concept of currency futures. By the weekend, we must be talking about the currency options.
Mr. Piri,
Yes, please.
I didn't see smoothing in your explanations. I don't know whether smoothing is in one of these explanations.
On interest rates.
Or smoothing is on interest rate.
Yes.
Okay.
Okay.
And
go ahead.
sorry, Mr. Piri.
It's okay.
I've just noticed that there are not so many points on leading and lagging.
Yeah.
And I think the other exam it was examined, it was leading and lagging, then smoothing, it was carrying 6 marks.
Because it's covered on the FM paper. So
Okay.
yeah, that's where it's covered a lot. So here, that is why we don't spend so much time, because these are the methods that are covered on FM or former F9.
Okay.
Okay. But we can repeat, a lead is to make an advance payment. If somebody has invoiced you $500 now, and it says that you can pay me on 1st of August. And what you know is that 1st of August, the currency will be very expensive. You pay now, pay in advance. So that you take advantage of the cheaper rate now. But if if you know that actually the payment will be much cheaper, the dollars will be much cheaper in August, you delay the payment. You delay the payment. So you either make an advance payment or you delay. What are you taking advantage? We want to take advantage of the rise and fall or the fluctuation in the exchange rate.
Okay.
Okay. All right, so people, Tuesday evening, we continue with our currency risk. Meanwhile, I spent some time, those who did the work, to go through so that they can see But my basic check on Excel, those who submitted, I think basically the skills seem to be good, but I'll go in detail to make sure that the concept of the premium on acquisition was properly dealt with there. All right, people, we see you Tuesday.
Okay, thank